So in this video, I'm gonna cover the problem-solving portion of Inventories, Section 3 for Lesson 3 Assets and Sale for CMA Part 1. So to start with, here is the outline of this lesson. So first, I'm gonna cover the problem-solving portion for the inventory accounting system. So just a recap, we have two: perpetual inventory system and the periodic inventory system. Then second portion, I'm gonna cover the inventory cost flow methods. So I'm gonna provide different examples for the different methods. So we have specific identification, moving average, weighted average, FIFO, LIFO, LIFO periodic, and LIFO perpetual. Okay, so to start with, just a recap again. So we have two inventory accounting system. So first one is perpetual inventory system and the second one is periodic inventory system. So what's the difference between the two? So under perpetual inventory system, whenever there are purchases, these purchase transactions are directly reflected in the inventory account. Similarly, whenever there are sales transactions, so basically, inventory and cost of goods sold account are automatically adjusted. On the other hand, when we say periodic inventory system, so purchases are only tracked in a separate account, which is the purchase account. It's a temporary account, meaning the beginning inventory account remains unchanged until the end of the period, and that is during the physical count of inventories. So we are saying here that any changes in inventory and cost of goods sold are only recorded at the end of the period, and that is based again on physical inventory count. So again, under perpetual inventory system, the inventory account itself is being recorded whenever there are purchases, and inventory and cost of goods sold are also recorded whenever there are sale transactions. On the other hand, under periodic inventory system, whenever there are purchases, only the purchase account is being recorded, and this is a temporary account, meaning the beginning inventory account remains unchanged. And then the inventory account and cost of goods sold account are only recorded at the end of the period, and that is based on the physical inventory count. So I hope that is clear. So now let's go to the problem solving. So we have here examples. So here, let's take a scenario. So we have a beginning inventory of 1,000 units. Each unit cost $5. Okay, so for the year 2 transactions, for instance, during March 1, the company sold 500 units for $5,000 US dollars in cash, and that is the selling price per unit is $10, okay? In June 2, the company purchased 250 units of inventory, which cost $5 US per unit. So, if we are gonna do the math, 1,000 units of inventory, beginning inventory, we deduct 500 units for the inventory items sold in March 1, and then we add 250 units for inventory purchases in June 1. Therefore, our year-end inventory is 750 units. Okay, so let's see the accounting entries under the two systems. Okay, so under perpetual inventory system, for the March 1 transaction, the company sold 500 units. Okay, so it is $5,000 US dollars in cash. So the entry here is we debit cash for $5,000 US dollars, and then we credit sales for $5,000 US dollars. Then we record the cost of goods sold, that is 500 units multiplied by the cost per unit, which is $5 US dollars. Therefore, the cost of goods sold is 2,500. Okay, so here the accounting entry for the sale portion, or for the cost of goods sold, that is debit cost of goods sold 2,500, and then we credit inventory for 2,500. Okay, now for the June 1 transaction, the company purchased 250 units and the cost per unit is $5 US dollars. Therefore, when we multiply 250 by 5, we get 1,250. Okay, so the entry here is debit inventory 1,250 and then credit cash 1,250, assuming the company purchased these inventory units on cash basis. Okay, so now at year end, when the company conducts the physical inventory count, since we have recorded the purchases and sale when the transaction occurred, there is no journal entry needed. We just maintain a running balance of the ending inventory, and that is 750 units. Okay, so that is 1,000 less 500 plus 250. On the other hand, when we say periodic system, okay, so see, the difference now is for the sale transaction, March 1 transaction, going back, the company sold 500 units, right? For 5,000 US dollars in cash. So we record this sale transaction the same way with perpetual system. So here we debit cash, we credit sales for 5,000, okay? So as you can see here, under periodic system, we don't record the cost of goods sold and inventory. Okay, so as I've mentioned earlier, under periodic system, the beginning inventory remains unchanged. Okay, however, for the June 1 transaction, we record the purchases, which is 250 multiplied by 5. So we get 1,250. Okay, so here, we actually debit purchases. This is a temporary account. We credit cash for 1,250. Now at year end, when we conduct physical inventory count, for instance, if the physical inventory count is matching with the running balance of ending inventory, considering the computation. So for example, same goes. Beginning inventory is 1,000 units less 500 units sold plus 250. So if we calculate, that is 750. Assuming that the physical inventory count is the same with our calculation, right? So here, we adjust the inventory balance. So we debit inventory ending, that is 750 units multiplied by the cost per unit, $5. So we get 3,750. And then we debit the cost of goods sold, that is 2,500. So here the cost of goods sold is equal to the 5,000 that is equal to 500 units multiplied by the $5 as the cost per unit. So we get 2,500. Okay, and then we credit the inventory beginning. So the inventory beginning here is, you can see we have the data here. You just multiply the 1,000 units by $5 per unit, okay? And then, as I've mentioned earlier, the purchases account is a temporary account. Since it's a debit, here we credit it. So we credit the purchases to close this temporary account, okay? So we credit 1,250 of purchases, okay? So that is the accounting entry at year end upon the inventory physical count. Okay, so that's the difference between the two. So just a short recap, the main difference between the two, here under periodic system, we don't record the cost of goods sold and inventory. Also, at year end, we record the entry for periodic system. On the other hand, for perpetual inventory system, we don't record such transaction because, as what I mentioned earlier, everything is already reflected when the transaction occurred. Okay, I hope that is clear. So now, if we are to summarize, how did we arrive at the cost of goods sold? Again, we have here beginning inventory, 1,000 units multiplied by 5, which is the cost per unit. That is 5,000 US dollars. And then we add the purchase of inventory. That is 500 units multiplied by, that is 250 units multiplied by 5 per unit is 1,250. And then the ending inventory, that is 750 units multiplied by 5. So we deduct the 3,750, okay? And then we get the cost of goods sold, that is 2,500, okay? So let me know if you have questions, comment down below, and then I'll try to answer them, okay? So now let's discuss, or let me provide you examples for problem solving for the inventory cost flow method. So we have here several methods. First is specific identification. Second, moving average method. Third is weighted average method. Fourth is first in, first out, or we also call this as the FIFO. And then the last in, first out, or the LIFO. And then the retail inventory method. So just a short recap, when we say specific identification, this method is used if the specific inventory items are specifically identifiable. So there's no computation needed here since it's easily identifiable usually, okay? On the other hand, when we say moving average method, so this is the one of the methods of the average method for perpetual inventory accounting system. So basically here, we actually determine a new weighted average inventory cost after each purchase transaction. On the other hand, for weighted average method, here this applies to periodic inventory accounting system. So the average cost here is determined only at the end of the period. So what we actually do here is we add the cost of beginning inventory, the cost of purchases during the period, and then we divide this by the total units of inventory available for sale during the period. And then we get the weighted average cost per unit. Okay, so for first in, first out, or the FIFO, here, what happens is this method assumes that the first goods purchased are also the first goods sold. Therefore, the ending inventory consists of the latest purchases. Okay? On the other hand, when we say LIFO or last in first out, so this method assumes that the newest items of inventory are sold first. Okay? Therefore, the remaining items are the inventories which are the oldest, or those which have been purchased first. Okay, so for the retail inventory method, I will discuss this further in the succeeding slides. So now let's proceed to the problem solving. So we have here examples. Okay, so let me first discuss the specific identification. Okay, sorry. So specific identification, so these requires determining which specific items are sold and therefore reflects the actual physical flow of goods. So when do we use specific identification? So this inventory system or cost flow method is used and is appropriate for first when the items are not ordinarily interchangeable, meaning the inventory items cannot be interchanged. Okay. Second, when the items are segregated for a specific project. For example, if a company has a specific project and then the inventories which are required for that project are also specifically identifiable, so we use the specific identification cost flow method. Okay, so it's easy, it's very simple for this one. So now let's proceed to a sample problem for moving average method. Again, this applies to perpetual inventory accounting system. So I have here a table. So as you can see, I have here the first column pertains to the date of the transaction. Second column pertains to the transaction itself. So we have here beginning balance of inventories, and then purchase transaction, sale transaction. The third column pertains to number of units. Okay, so for example, beginning balance as of January 1, you have 100 units, okay? And then March 1, the company purchased 20 units of inventories. In April 1, the company has sold 70 units. June 1, the company has purchased 30 units. October 1, company sold 40 units. On the fourth column, we have here the purchase price per unit. So for example, the beginning balance of inventory, the purchase price per unit is 20. So for March 1 purchase transaction, the company purchased 20 units, which cost $32 per unit. The last column pertains to the sale price per unit. For example, in April 1, the company sold 70 units of inventories for $40. Same goes with October 1 sale transaction. The company sold 40 units at $24. So now let's proceed to the calculation. So how do we calculate for the ending inventory under the moving average method? So as I mentioned earlier, these applies to perpetual inventory accounting system. So as I've explained, under perpetual inventory system, the company records a transaction whenever there is a purchase or sale transaction. For example, in the accounting system of the company, the average cost of the inventory is actually moving whenever there is a purchase transaction. So the average cost of inventory per unit changes whenever there is a purchase transaction. So here, we need to reflect it in our computation, okay? So for example, January 1 transaction, the beginning balance, the company has 100 units of inventory which cost $20 per unit, okay? So here, if we see in the inventory total balance column, we have $2,000 and that is computed by 100 units multiplied by $20, okay? In March 1, the company has purchased 20 units and the purchase price per unit is $32. Now, if we are gonna compute the cost of inventory purchase in March 1, it costs $640 and that is computed by multiplying 20 by 32. And then the next step here is we simply add the cost, total cost to date. As of March 1, after the purchase transaction, how much is the cost of the inventory? So take note, we have the beginning cost, right? $2,000, and then we add the 640 cost for the inventories purchases of March 1. Therefore, the total inventory, total balance is $2,640 and that is for 120 units. So 100 units plus the 20 units purchased in March 1. So the total units on hand as of March 1 is 120 units. Now, if we are going to get the cost per unit, we simply divide the total cost of the inventory as of March 1 divided by the total number of inventory of units on hand as of March 1. So 2640 divided by 120, or we get $22, which is the cost per unit. On April 1, okay, the company has sold 70 units. So here, as of March 1, right? As of March 1, the cost per unit is 22. Here, we multiply the 70 units of goods sold by the cost to date, which is $22. Therefore, the cost of inventory sold as of April 1 is equal to 1,540. That is 70 multiplied by 22. Now, if we get the running balance of the inventory, here, as you can see, we have 1,100, and that is computed by the running balance of inventory as of March 1, 2,640, and then we deduct the cost of inventory sold as of April 1. So 2,640 less 1,540, that is 1,100. Okay, and then we get the units on hand as of April 1. So remember, as of March 1, we have 120 units in total. We sold 70 units on April 1. Therefore, 120 less 70, we have remaining 50 units on hand as of April 1. Okay? So take note here, our cost per unit is still the same. So that is the remaining running balance of inventory, which is 1,100 divided by 50 units. We get $22 is the cost per unit. Okay? On June 1, the company purchased again 30 units of inventory items, and the cost of the inventory per unit is $14. Now, if we are gonna compute for the cost of inventory purchase, that is equal to $420, and it is computed by multiplying 30 units multiplied by $14 per unit. Now, if we gonna get the inventory total balance, take note, as of April 1, the running balance of inventory is 1,100. We purchased $420 worth of inventories as of June 1. So we simply add the running balances of April 1 and the total cost of inventory purchase on June 1 transaction. Okay, so 11 plus 420, we get to 1,520. And then we get the units on hand as of June 1. So remember, as of April 1, we have 50 units, and then we purchased 30. So that is 50 plus 30, we get 80 units on hand of inventory. Okay, now, as I've mentioned earlier, for perpetual inventory system and moving average method, we actually calculate a new average cost of inventory whenever there is a purchase transaction. Here, in computing for the new average cost of inventory per unit, we divide the total running balance of inventory, that is 1,520, divided by the total units in hand, which is 80, and then we get the new cost per unit, which is 19. Okay, on October 1, the company has sold 40 units. As you can see here, the cost per unit of inventory sold is $19. So we multiply 40 by 19, we get 760. As of October 1, if we are asked how many inventory units are on hand, we say 40. Okay, so here, inventory items as of June 1, 80, less the number of inventory sold in October 1, 40. So the remaining balance is 40. And then we get the remaining balance of inventory, that is 1,520 plus 760. So the ending balance of inventory as of October 1 is $760. So let me know if you have questions. So I don't know if I'm very fast in this portion, so I hope this is clear. So now let's go to the weighted average method, and as mentioned earlier, this applies to periodic. Okay, so here, how do we compute for the weighted average cost per unit? So first, we compute for the numerator. For the numerator, we add the beginning balance of inventory, or the cost of beginning inventory, and then we add the cost of purchases during the period. And then we also compute for the denominator, that is, we add the number of units in our beginning inventory plus the number of units of purchased inventory during the period. And once we compute for the numerator and the denominator separately, let's divide the numerator and the denominator, and we get the average cost per unit of the inventory. So for example, in our problem before, we have the cost of the beginning inventory, which is valued at $2,000. We add the total cost of inventory purchases during the period, that is equal to 1,060, and then we divide by the total number of units during the period. So the beginning number of units is 100 plus there were 2 purchases, right? 20 units plus 30. Okay, therefore, we have the weighted average cost per unit, and that is 20.4. Now, if we are asked how much is the cost of goods sold or the ending inventory, we simply compute for the ending inventory first. So, as you can remember, in our previous problem, the ending inventory is 40 units. We simply multiply the 40 units of ending inventory by the weighted average cost per unit. That is 20.4. So, we get 816. And then we just do the math. Beginning inventory plus purchases, that's ending inventory, we get the cost of goods sold. Or there's another way we can compute for the cost of goods sold. We simply get the total number of units sold during the period and we still multiply it by the weighted average cost per unit. That is 20.4 multiplied by 110. We also get the cost of goods sold. So there are 2 ways to compute for the cost of goods sold under the weighted average method for the periodic inventory system. So now let's compute for the first in, first out, or the FIFO. So here is the same problem. As I mentioned earlier, for first in, first out, this method assumes that the first goods purchased are the goods which are also first sold. Therefore, the ending inventory consists of the latest purchases. So if we are being asked how much is the ending inventory, since the ending inventory consists of the latest purchases, so if you can see here in the table, the latest purchase transaction is June 1, okay, 30 units. Therefore, we get the whole of the 30 units multiplied by the purchase price per unit, that is $14, we get the 420. And remember, the ending inventory is 40 units, correct? Therefore, we need 10 more units and we get the next latest purchase transaction, that is March 1. So we get 10 units from the 20. We multiplied it by 32. We get $320, and we simply add the June 1 transaction and March 1 transaction, that is $740, okay? And then if we are being asked how much is the cost of goods sold, again, we do the math. We first add the beginning inventory, $2,000. We add the purchases of 1,060. We deduct the ending inventory. So these ending inventories, you can see this is computed here, okay? 740. Therefore, we get the cost of goods sold, which is 2,320. So I hope that is clear. Now here is the summary. How did we get the 40 units of ending inventory? So in this problem, for instance, we have beginning inventory 100 units, March 1 purchases 20, less the April 1 sale transaction 70 units, and then we add the June 1 purchase transaction, which is 30 units, and then we deduct the October 1 sale transaction, which is 40 units. Therefore, we get the 40 units of ending inventory, and this is first in, first out. So in getting the cost of ending inventory of 40 units, we get the latest purchase transaction, that is 30 units from June 1 transaction, and we get the 10 units from March 1 transaction. So I hope this is very clear. So now let's go to the last in, first out, or the LIFO, inventory cost flow method. So this is the same example. So how do we compute for the ending inventory? So as I've mentioned earlier, under the LIFO, so this method assumes that the newest items of inventory are sold first. Thus, if we are being asked how much is the inventory cost of the ending inventory, we simply get the inventory cost of the oldest transaction, okay? So here, as you can see, remember again, the ending inventory in terms of units is 40 units. So we get first purchase transaction, that is, we go to the beginning balance, okay? So we get the 40 units from the beginning balance. We multiply by the purchase price per unit. So here, as you can see, 40 units multiplied by 20. This is taken again from the beginning balance, okay? So our ending inventory is $800,000. If we are being asked how much is the cost of goods sold, again, we just do the math. So beginning inventory, $2,000. We add the purchases, 1,060. We deduct the ending inventory. Again, this is computed by multiplying this way. Therefore, we get a cost of goods sold of 2,260. Lastly, what do we mean by retail inventory method? So this method is used for, so we have 3 ways. First, during interim and annual financial reporting, which is in accordance with GAAP. Second, for federal income tax purposes. And third, for verifying year-end inventory and cost of goods sold data. So for example, as an analytical procedure by an independent auditor. So that ends this lesson. I hope this has been helpful to you. Comment below if you have questions or clarifications. My name is Jane. Thank you for watching. If you like this video, hit like, share, and subscribe. Till next time.
Ooh.